So the riddle right now for central banks and for investors is whether you can fight inflation by raising interest rates without tanking other parts of the economy, and notably this week, the banks. Well, earlier this week, I spoke with Tom Porcelli, Managing Director and Chief US Economist at RBC Capital Markets in New York. Just to explain, Tom started his career at the Federal Reserve Bank of New York, working on the open market desk. So in other words, Tom's worked directly on US monetary policy and has grappled with this problem firsthand.
Powell gave us sort of a pretty decent sense for that during his press conference. They just simply don't know the extent of the damage that's going to come from credit conditions on the back of the bank issues that we've been dealing with, and as a result, it seems like they're starting the process of backing off now. I mean, just remember, two weeks ago, right before the weekend bank issues started to pop up 2 weekends back, this was a Fed that was completely content with the market debating whether the Fed was going to get to 6% as a terminal. That conversation is now completely off the table. I mean, the Fed seems to sort of think that at best, you get one more rate hike. And we're not even convinced that's going to happen. In fact, Powell didn't seem convinced that one more was going to happen in May either. So I think he understands the gravity of the moment. Again, despite the fact that they raised rates, which I don't think that they should have at this meeting, but I think it would have been a hard transition for him to go from again, having us wonder if 6% terminal was possible, to saying, hey, the cycle's over and we're going to reverse course quickly. Although I think that's exactly what's going to happen.
Okay, but isn't this really trying to grapple with the lesser of two evils? In other words, the prospect that you have banking pressures which have come about, which we've seen take place with SVB and Signature and Credit Suisse, or indeed that there's ongoing and enduring inflation, which itself is damaging to economies?
Yeah, so I think, look, it's a totally fair discussion point, and so let's sort of get into that a bit, because I think what we have to recognize is what is the direction of inflation right now. The direction is slowing, and that's not just it's not a flash in the pan, right? It hasn't just happened once or twice over the last couple of months. Inflation's been slowing down since September. Sort of very consistently, month after month, inflation is slowing down. Moreover, there's pipeline disinflationary pressure. You're seeing it in things like PPI, the producer price index, right? The wholesale price index. There's quite a bit of evidence to suggest that in the coming months, inflation, the direction of travel from an inflation perspective will continue to be one where you're seeing it slow. The banking crisis, these banking issues that we seem to be dealing with, this is new. In a lot of ways, it's unknowable what the impact will actually be. So I would actually argue that it's absolutely right for the Fed to be focused more on the bank issues than on this massively lagging economic indicator known as inflation that's already slowing down and has been slowing down for a number of months now.
So, Tom, even the banking issue is unusual because normally what happens is you have a credit problem that causes collapses of banks. In this particular case, it's a mismatching of the investment portfolios. So even in historic terms, with the banking crisis at Credit Suisse, at Signature, at SVB, it's actually a different problem that would normally come from raising interest rates as aggressively as the central banks have.
Yeah, well, look, I think the catalyst was different, but the end result is, potentially going to be the same, right? A tightening of credit conditions. One of the things we've been pretty fond of highlighting over recent months at RBC is if you look at the delta, right, the change in lending standards in the United States over the last 4 quarters, the change outside of the pandemic. The change that we've seen in in the last 4 quarters is the most significant we've seen since the Great Financial Crisis, right? The GFC of 07, 08, 09. That's meaningful. Now, in fairness, the level we're coming from is much lower. But again, direction of travel. That's what we find very compelling. The change has been dramatic, and now you layer on top of that these potential issues coming out, or new issues coming out of the banking system. And again, I think it's really easy to make the case that this will continue to tighten lending standards. And unless we forget, you think about the things that have really driven consumption in the United States, even more meaningfully recently than what we've seen in the past. It's been a drawdown in saving, which now is almost getting tapped out. And the other factor has been credit usage. Credit usage has been meaningful. And so now we're going to stunt one of those other, that sort of this key source that the consumer has been tapping into.
And yet you've still got the central bank putting enormous amounts of liquidity into place to make certain that banks do not fall over. Now, that in itself historically would be inflationary because it gives the banks an ability to keep lending, keeps an ability for consumers to have money in their pockets. There's no constraint going on there. So this is almost a reversal of policy, even by what they're doing in coming to the rescue of these banks.
Well, I'm not so sure about that. What I would say is I think that what the Fed did, I think they did out of necessity. And I think they needed to make sure that the banking, this is true not just in the United States, this is true anywhere. The banking system is the lifeblood of most economies. It's how borrowing and lending takes place. It's how people buy, sort of big ticket items, even some small ticket items. So I think it was necessary for the Fed to have gone down this path. So I don't know that's quite a fair characterization. I mean, look, one of the things I keep on hearing is, well, the Fed's balance sheet is rising again. Yeah, but the Fed's balance sheet is rising for different reasons, right? This is not, the Fed, buying more assets. This was the Fed lending money to a distressed bank that they did not want to become a systemic event.
So then take me to the whole point about the future and where it goes to, because it almost seems to me like a game of whack-a-mole at the moment where, you sort of knock one on the head, but something pops up somewhere else. Do you sense calm coming across that banking industry now? The markets certainly have interpreted that short term, but is there the prospect that there are more, given the fact that the Fed has again raised interest rates and that's going to put some pressure on elsewhere?
Yeah, look, I take as an economist, I take the economic view on this. And the economic view is the economy was already slowing down in the United States, right? Even before this. The first half of the year is probably going to look pretty decent. Q1 growth, when we finally get that in a month or so, it's going to actually probably be pretty strong. It's probably going to want to be like 3%. Q2 will be a little bit slower, call it, roughly 2%, maybe a little weaker than that. But then when we get into the second half of the year, the second half of the year is going to look very different than the first half of the year, which again, let's just call it in round numbers, is going to average 2 to 2.5% growth. I think the second half of the year could easily be negative. Now, I think right now it's a small negative. So it's about 0.1%, but for round numbers, let's just call it flat. So without this banking crisis, you're going from, in round numbers, 2% first half growth to 0 second half growth. You layer on top of that the sort of some of the stresses that we think are coming out of the banking system, which, as I said, will bleed into tighter credit and tighter lending standards. You're probably looking at maybe an additional 0.25 percentage point subtraction. So most of the damage from an economic perspective, we think was done even before this. And so by comparison, the banking crisis, again, assuming it doesn't get worse from here. I mean, we reserve the right to change that view if this gets worse. But as of right now, most of the slowing was already in tow even before these bank issues arose.
And so, Tom, according to your theory now, when's the first cut in the Fed's rates?
Yeah, so we had, again, long thought that the Fed would cut in the second half of the year. We thought that you'd see 2 cuts just before the end of the year. I think it's entirely plausible that got pulled up a bit. Maybe they now go in September. The market right now is pricing July. I think July seems too soon for the Fed to hike, for the Fed to cut. I think the challenge for the Fed is going to be, again, one of narrative. I think the next big fight for the Fed with the market is going to be to push back on this idea of them potentially cutting in July But again, if we thought maybe November, December for the first cut, I certainly can see a plausible argument that is now going to be September. Again, on the back of what we witnessed here. So to me, that's again, that will be the first of what will probably be at least a few cuts. But again, a lot of that was already in place on the back of the economic slowing that was already in tow.
Tom Porcelli, Managing Director and Chief US Economist at RBC Capital Markets. Great to have you on the program today, and many thanks for your time.
Thanks so much. Good to be with you.